A pleasant day to you, homeowners and potential homeowners. If you want to know the simplest way to pay off your mortgage or your car loan early and eliminate your two biggest debts, then please watch this video to the end. The information that I'm about to give to you is something that I have done personally, and so I promise you it works. Now, let's take a look at the amount of interest you pay on your mortgage loan and how a small change in the way that you make your payments can save you thousands of dollars. Now, I know that this option might not work for everyone. And also keep in mind that we are not here to demonize the banks in any way. If it wasn't for the bank, you would not own a home and therefore no wealth generation, okay? The majority of us do not have the cash to buy a home. Therefore, we do need the banks. I'm just trying to show you how to keep some of the interest that you would normally pay in your account. The first and only rule is to keep it simple. Pay an extra amount that you can afford to pay each month along with your regular monthly payment. It doesn't have to be the same amount every month. Some months you might have extra payments and some you may not. If you have a month or two that you cannot make the extra payment, it is okay. Just make your regular payment and don't be late. However, you should try to be consistent with the extra payments because this is where you are going to make a difference. Make sure the bank applies your extra payment towards your principal. This is crucial because if the bank is not told how to apply this money, they would put it towards your next monthly payment, and this is not your goal. This goes for both your mortgage and your car loan as well. Interest is applied to the loan balance, so the less you owe, the less interest you will pay. Now, when you receive your statements each month, you will notice that your principal balance have been reduced. This, in turn, causes the interest you owe to decline. Remember, be consistent with those extra payments. Any amount helps. The next option is to make a lump sum payment at the beginning of each year. Why, you ask? Because paying in January will lower the amount of interest you pay for that year, since you have reduced your loan balance. Waiting until December means that you have already paid all the interest for that year since your loan balance was not reduced at the beginning. The quicker you reduce your principal, the less interest you pay over time. It's a win for you, the borrower. What is important is that you are chipping away at the loan balance every chance you get. This option can also be coupled with the first option, where you can make the extra monthly payments and then you can make also one lump sum payment from maybe your tax return if you receive one. Another option is to refinance to lower your interest rate and shorten the loan duration. That would be from a 30-year to a 15-year if you had a 30-year mortgage. Also, lowering your interest rate. But you have to be careful here because refinancing will only make sense if you are going to be staying in your house for a very long period of time, or if there is going to be a significant drop in your interest rate. Let's go ahead and take a look at a breakdown of the key components of a loan. First, we have the loan amount. This is the total amount of money that you have borrowed from the bank. Next is the interest rate. This is the annual percentage rate charged by the lender or the bank on the loan that you have borrowed. Then we have the loan term, and this is the duration over which the loan is to be repaid, whether it's 15 years or 30 years. And finally, your payment amount. Here, the bank tells you, the borrower, how much principal and interest payment you will be making each month. Now, this does not include your taxes, your insurance, your homeowners association dues, or your mortgage insurance if there's one on your loan. Okay? For the monthly payments, you, the borrower, makes a fixed payment that covers both your principal and your interest, with the majority of the payment going towards the interest and a very minimal amount going towards the loan balance. The interest is calculated on the remaining balance of the loan each month. Let's suppose that you have just bought your home and the loan amount is $500,000 with an interest rate of 6% over a duration of 30 years. That would make your monthly payment $2,997.75. As you can see, $2,500 of that payment will be applied towards your interest, and only $497.75 will go towards your principal or your loan amount. For the first 15 years of a 30-year mortgage, the majority of the payments will be applied towards the interest. Having a clear understanding helps you know how your payments are allocated. Have you ever heard of an amortization schedule? It is a detailed table of each payment you will make over the life of your loan. It shows not only the total monthly payment, but also how much of each payment goes towards the principal, that's the amount you have borrowed, and how much goes towards the interest. In the early stages of your loan, a larger portion of each payment goes towards the interest. A fully paid off home, for instance, is not just a place to live. It becomes a tangible asset that can provide security and even offer opportunities for wealth building. With each payment that reduces the principal, you are effectively gaining wealth as you are increasing the equity in your home. In a broader sense, eliminating this large debt also allows you to reallocate funds towards other financial goals, whether that means saving for retirement, investing in stocks, mutual funds, or buying more properties. If you're able to find your closing package, take a look and see if you can find a document called Truth in Lending Statement. The top portion should look like this. This document will show you how much you've borrowed, the interest rate, how much interest you will pay over the life of the loan, and the total amount of money you will pay in the end. We're going to use the $500,000 example as the purchase price with a 6.38% annual percentage rate over a 30-year term. At the end of the 30 years, the total interest paid on that $500,000 loan would be $623,555. At the end of the 30 years, you would have paid to the bank a total of $1,123,555. Just think about that for a minute. Let it sink in. And yes, I know you don't have the cash to make the purchase, but you also don't want to end up paying over $1 million for a $500,000 house. Take a look at these amortization schedules showing the difference between normal payments and extra payments each month for the first year. In this case, we are going to use an extra payment of $200 each month. Notice how the extra payments chip away at the balance you owe faster, lowering your loan balance. Now, let's take a look at year 2. Do you see the difference? Every month, your interest is calculated on your remaining balance. Keep that in mind. The lower the balance, the lower the interest. Now, let's take it a bit further and go to year 3. Take a look at your principal balance. As you can see, it is in your best interest to attack your principal at every opportunity with any extra amount that you can sacrifice. The important thing is that you find a method that works for you and you get it started now. Start with your next payment. Search the internet for an amortization calculator with extra payments. Play around with it by adding extra payments of different amounts and look at the result. Financial freedom is possible for everyone, and remember, keep it simple. Proverbs 22 verse 7 states, that the borrower is slave to the lender. So get those loans paid off. Now, another important fact. Once your loan is paid off, you will be responsible for your property taxes and your insurance. So watch out for the tax bill in the mail. It usually comes around October, and it's due by the end of March. Don't let the government take away your house now that it's fully paid for. Pay your property taxes. To get an idea as to how much money you will need to set aside for your taxes, go to your property appraiser website or the tax collector's website and look up your tax bill. Search by your name or by your address. Also, you will have more flexibility when buying homeowners insurance, so shop around, talk to different agents, and learn about all your options. You will have more options by owning your home than when you have a mortgage and the bank tells you what type of policy they want. I thank you for taking the time to watch. Please subscribe, like, and share with others if you find this video helpful.